Hey everyone, welcome to this edition of the Quantum Mailbag. In this video, we're going to be talking a bit about one of the most common requests we get from customers that we just absolutely have to address. It's a huge topic that comes up. It comes up all the time. And when we started the mailbag, the original goal was to be able to go out and to help customers with the common questions that they brought up all the time. We explain option topics, we share tips and tricks with our tools, we sort of help people understand the right process for using our tools to solve some of the common problems. But if we charged for customer support requests, the majority of our revenue would come from one specific topic, and we just need to put an end to it right now. So this video is dedicated to solving that. Every time Tom Cruise releases a new blockbuster, we just get this influx of requests. And I think it's because people are going through the back catalog and watching all the big movies. And of course, recently this weekend, the new Mission Impossible movie came out. So our inboxes are getting flooded with tons of requests. And just to cut them all off right now, no, we cannot help you do a Mission Impossible 2. It's not going to happen. Please stop asking, and don't create like other accounts and come back and ask the question a different way, because we can see right through it. We know exactly what's going on there. Now, the summary of the movie is simple. Like, there's this virus that the villain has. He also has the cure for the virus, and what he wants to do is he wants to release the virus into the wild, create a worldwide pandemic, as unbelievable as that might be, and then sell the cure through a pharmaceutical company. But he doesn't just want to make a lot of money. He specifically wants a controlling interest in the company so that he can pretty much take it over. And he plans to do that by acquiring the majority of stock. And stock is the way you do that. You buy 51% of the stock and then you own the company.
Stock options, to be a little more precise.
Sean, we've been over this. You want the stock. The stock options aren't really going to help you here. The options, it doesn't work like...
Stock options, to be a little more precise.
All right. Well, he's the boss. He's got the controlling power right now as far as this video goes. And so in order to help everybody understand what the point of the movie was and what was going on there, let's talk about stock options. So keep in mind, this movie was written in the late 90s. It came out in 2000. So this was the height of the dot-com boom. This is when you didn't have to understand options at all, whether you were working at a hot new tech startup or if you were writing the next Hollywood blockbuster. So as a result, let's assume that the audience didn't have a great deal of understanding other than the idea that these were like these magical instruments that helped you make a ton of money. However, there are some fundamental things that may lead me to believe that the writer did know what they were talking about and just wanted the villain to look foolish. And so setting up the villain that way would be a really long game. And, it might take a couple decades for somebody to take the time to break it down for everyone, but here we are. So the plan was pretty simple from a finance perspective. The villain was going to buy calls in the pharmaceutical company BioSite. Then what they were going to do is they were going to release the virus. And then they were going to take the cure, sell it through BioSite so that they could actually provide this cure, make a ton of money, and then they were going to leverage the gain in the calls to attain a majority stake in the company. And it's a little bit far-fetched and a little ridiculous, but there's some parallels here, and I think there's some value in going through it in a bit of detail, just so that everyone gets on the same page here. Now, we're going to set aside a bunch of stuff, like all laws and regulations, all tax implications, and of course, some of the common sense laws of physics. I mean, literally during the scene, while he's negotiating the purchase of the calls, he takes a phone call where he instructs his henchmen to release the virus into the wild, giving them a 72-hour window to manufacture and deliver and produce and actually inject the cure into all these people. So let's just look at the finance. All right, now, and we can look at the finance because there's a ton of details. I mean, the villain spent a lot of time like just thinking it all out, because they talk about a bunch of specific numbers in the movie that actually give us a way to analyze what the trade was and what the probabilities were and the likelihood. Most of it's not super necessary, but let's just talk about the gist of it, because again, we just can't answer these support requests anymore. It's taking up too much of the day. So he probably had an Excel sheet banged out somewhere. It's a great reminder about why Quantia is the tool you should be subscribing to if you are planning to make huge options plays and manage complex books. But for the purposes of this, we weren't around back in 1999, 2000, so it wasn't an option. So I don't really blame him so much. Now let's talk about the trade and math here. So the first thing that comes up is that BioSite has 93.4 million shares outstanding. This is a This is brought up in the movie. A lot of these facts are just delivered in one scene. It's about an hour and 32 minutes in, if you want to check it out before you, so you can catch up to where the rest of us are. Apparently all of our customers watch this movie on continuous repeat, so I'm assuming that if you're watching this video, you probably already know this by heart. Now, he also mentions that the stock's never traded above $31 a share. No talk about what it currently trades at, but we'll assume it's in the ballpark of about $30 a share for the sake of analysis. We do want to have some numbers to work with here. Now, this would make the market cap of the company around $2.8 billion. Not super necessary to know that, but it just helps us get some numbers that make sense. Ambrose, the villain, wants to buy 480,000 calls. Right? That represents 48 million shares of the company, which is a 51% stake about. The exercise cost, of course, being $1.4 billion. Now, he doesn't want to borrow $1.4 billion to buy half the company. He wants to find this like free and clear way to leverage these calls into being able to acquire 51% of the shares. God, now that I think through it, I feel kind of dumb just for saying that, but yeah, so part of this video is talking about why you can't take options to acquire shares for more than the value of the options. And anyway, so we're going to break it down pretty well, I think. He also points out that he wants to borrow $30 million from the CEO that he's holding under duress in order to acquire all of these calls. So this gives us enough information to kind of build a generally good picture. So this translates to about 62 cents a share. So we're going to be able to track down the exact option he would have been buying in this scenario to actually get to the point. So in order to do that, we'll think about, he probably wants to trade the shortest dated option available in order to provide the most leverage, right? The shorter the date for the option, if they're all at the same strike, generally speaking, what you'll find is the least amount of time value. And I'm trying to avoid all little caveats here and there about, well, what if there's dividends and what if there's that? So I'm going to cut a lot of corners in the video to just kind of understand the spirit of what we're talking about here. So he wants the shortest dated option. And now BioSite, because we're talking about really back in the last millennium, like at best they were trading quarterly options, which means that they would expire in March, June, September, and December. And it was the third Saturday back then of each of those months. Now, of course, as all of the fanatics of the movie know, it takes place in late March 1999. This is an important factor because the movie was released in the summer of 2000, but it takes place in March 1999, as you all know, because of that scene with the newspaper, right? The newspaper where it clearly says Monday, March 22nd, 1999, to show people that somebody had the money to buy the cure as a bid. Of course, I don't have to tell you that. You already knew it. Now, let's get into some of the details. So if it's March 22nd as a Monday, that means the 20th would have been Saturday, which is the third Saturday of March. So March already expired. So at this point, Ambrose knows he's buying the June calls. And so that's about 90 days out. That gives us a little bit of a window to work with. And so now we just have to figure out the strike. So there's a couple ways we can do that. The first thing we're going to do is I'm going to step out to our data up on NASDAQ. We're going to go ahead, I'm going to refresh this. We'll get in. And let's see, hopefully this won't take too long to get to our data. So what we're looking at here is this is our volatility data available on NASDAQ. I highly recommend downloading it if you want to do some of these great analyses for yourself. So what we're going to do is we're going to find the 90-day call implied volatility here, which is here in that color, and then I'm going to get rid of the historical volatility 10-day. And if we kind of just look along at Pfizer, which is I think a comparable biotech to BioSite, we're seeing numbers that are roughly in the neighborhood of 20% implied volatility for the 90-day term under ordinary circumstances. There's a couple spikes in here that probably had to do with very specific market conditions that were going on, but we're saying, okay, back then, even when we look back here, we're looking at about 20% long-term implied call volatility for the 90-day range. So we'll head over to Quantia, and then we'll check out the Quantia screeners, and we'll take the stock screener specifically here, and we'll say, let's find a stock with implied volatility. We only have the 30-day exposed in the UI, so you can get more with the API, but for now, we'll do that. We'll kind of say 18 to 22% range, and we probably want to look for a stock that has at least fair option liquidity, because keep in mind, we're going to look 90 days out. So we're looking at about 2 to 3 months out, and to figure out what exactly the volatility is. Now, we've got a few of these guys. Let's take a look at a comparable price here. So we'll say under $40 a share, since we think it's about $30. And we want no earnings. So this one's actually pretty good. I think British American Tobacco, another healthcare company, obviously, we'll use these guys. So we'll go out to the September timeframe. So now what we're doing is we're kind of using these as a proxy for what the option chain would look like for Biosite at the time. Roughly similar implied volatility at that term. And we can see that the at the money calls, right, are right now 60 to 70 cents. That's the bid-ask spread. So for this, actually a little closer to that, but somewhere in this range. So the point is, what we're seeing here is we're not talking about deep out of the money calls that he's buying. He's buying something roughly close to the money. So we'll assume $30 calls. And I think that's pretty good to know, and that can help us with the next step of the analysis. So let's go ahead and step back on in where we were here. So now we figured out the analysis there. So let's talk about how he's going to take over the company, because the expectation is he buys these calls when the stock's at 30 for $30 million. Then the stock's going to skyrocket up past 200. He says, upwards and over of $200 a share. And that would say if at $200 a share, those $30 calls they're going to zero out their time value. So they're going to be pegged at intrinsic value at $170 a share. So those calls will be worth $8.1 billion. That even accounts for paying back the loan for the money that he borrowed, under duress in order to be able to transact in the first place. So the problem is, I think this is where the movie breaks apart. The villain or the screenwriter or somebody, I think the mistake they made was that they forget that when the stock price goes up, it's not just for Ambrose, it's actually for everybody. So at this point, 8.1 billion in profit, it's sort of not going to work for the 1.4 billion that it would have cost to buy the shares at $30 a share. So in this case, the market cap has gone up for everybody. So, or the price has gone up for everybody. So the market cap is now 18.6 billion, which means you need 9.3 billion for half. So there's really no way to kind of structure this. So let's think about what he could do next. First of all, you can't exercise the options without the cash to pay for them. There's no like exercise now, pay later thing. Like you gotta pay your $30 a share. You got the strike, you get a ton of profit, opportunities there. Now, you can't sell enough options to finance the outright purchase of the majority stake. Like this is just trying to turn 8.1 billion into 9.3 billion just through accounting tricks. Like there's no scenario where that works. You can try it all the different ways you want. Like there's no way to sell a portion and then do it to exercise, because it all works out where he tops out at 43%. Now, you also can't borrow the money, exercise, and then sell some of the stock to repay immediately without losing the majority. And I know that he wants it free and clear. Like, he doesn't want to borrow 1.4 billion, or else he would have done that in the first place just to buy a majority stake in the company. So clearly, this isn't really an option here. Maybe he could liquidate the thing, buy up to like 36% outright, and then the remaining 14% on margin, with a little extra to get that majority. And speaking of which, like, why is he obsessed with the majority ownership in the company? Like, billions of dollars is fine. And with 43%, you can put yourself on the board. You can chair the board. I mean, there's a lot of power you have at 43%. I mean, Bill Gates and Mark Zuckerberg and Elon Musk and Jeff Bezos, I doubt any of them had anywhere close to a majority share when they went public. I mean, they chair their companies. That's just how it is. But anyway, like, I know I'm splitting hairs here, but come on, dude, like 43% is pretty good. I did do a little research and I found the shooting script for this, which is a little different from how the movie actually plays out. And a couple things to note. First of all, initially there was supposed to be a strike price of 50. 62 cents for a $30 stock struck at 50. I mean, you'd have to go out years in order to be able to find something that justifies that price, especially like you're already got the guy and you've captured and you have a weapon on him. It's kind of strange to negotiate these numbers. Like you could just say, give me the company at that point. It's not like you can commit a crime in order to take a stake in a company. And then if you sell out of the position before the police show up, they just let you go. I mean, you're in a lot of trouble. So I don't get that part. Also, the plan originally was to borrow against the option gains in order to buy the shares. But again, the shares are over $200 now. Like it's almost $10 billion. Like why not just go in the first place? And I'm sorry, the plan is insane, and I don't think that it could ever work. It's really not a good idea. But if you think about it, just a little bit. There's actually something to it that's kind of brilliant and has to do with market mechanics when it comes to how market makers hedge their books. So let's talk about that a little bit, because this has come up recently with things like GameStop, because you've heard of like squeezes. And so there's various kinds of, there's short squeezes and there's a bunch of option squeezes that can happen, especially when it comes to price movement with delta. So let's talk about market makers. So an option contract always has two sides. There's a long and a short. Whereas a company can issue a share and then people can just buy that share and pass it along to each other, it doesn't necessitate that a person is short a share in order for somebody to buy a share. Technically, the company is giving out the share, but it's a different concept there. Options don't exist until you create them out of thin air in a transaction in which at least one side is opening their position. So, or actually both sides, but we'll set that aside for now. The point is that there's always two sides to an option contract. When you buy an option, it's probably going to be from a market maker. This is just kind of just how the mechanics work. There's just not enough liquidity of people with open orders for long periods of times for enough of that volume to make up the majority. So you're typically buying from a company that specializes in being available to buy and sell options so that the market can exist. Now, they try to stay risk neutral, right? They're more dealers because their goal is to make money off the bid-ask spread. Like when Ambrose shows up to buy these calls, then they're going to be selling the calls. And their hope is that they can get those calls they can buy those calls back from someone else at a better price. Therefore, they make a profit. So they sell it to Ambrose at 62 cents, and then somebody comes along wishing to sell it to them as low as, let's say 60 cents. And then they make 2 cents a share profit on 480,000 calls, that is a good day. So to stay neutral, what they do is they hedge their risks. And these risks are all the kinds of things that go into option pricing, like the underlying price, so all the movement, your implied volatility, and of course, interest rates, which were a much bigger factor in recent years. So let's talk about delta hedging, which is the big thing here, because we know the expectation is going to be a huge upward move. And let's see how that would actually impact this scenario. Because what delta is for, it's the most important Greek because it measures how much an option's value changes when the underlying instrument it's based on changes. Because options are derivatives. They're purely derived from the value of other things. So when the underlying changes by $1 a share, the option is expected to change by the delta amount per share. So in this case, think of shares as having a delta of 1 by definition. So when a share is worth $1 more, it's worth $1 more. I mean, it is literally the definition of what a 1 delta would be. For options, it's a little different because their deltas can vary depending on all these different factors that go on at any given time. So at the money, a call's delta is 50. Now, what that means is that if the underlying goes up by $1, that the call should go up by 50 cents. If the underlying goes down $1, the call's value should lose 50 cents a share. Now, there's a bunch of stuff with continuous math and how these aren't exact straight line discrete movements, but we're going to set that aside for now. Just think of it as like that 50-50. And another important thing is that contracts represent 100 shares. So you often hear people talk about the 50 call, the 50 delta call, because it is $50, right? 50 cents a share times 100 shares. That's how you get to $50. There's also another Greek called gamma that sort of gives you an idea of how much delta should change every time the underlying moves $1. It's the second derivative. So it's kind of like the way delta is for the stock price, gamma is for delta. But the key thing to know is that when you're close to the money at that 50 delta, gamma is high. So delta is going to move a lot anytime the underlying moves. As you get further out, gamma gets lower and then delta moves much less until it approaches 0 or approaches 1 at the far end of the tails. Now, when a market maker sells a call, what they're doing is they're going shorter delta, right? And so they're going to need to hedge against that. And there's a few ways you can hedge. The first thing you can do is you can buy back the option you sold, right? So you sold a call to this person and then you can buy it back from that person. And then ideally you sell it for more than you bought it for and you make a profit. Alternatively, what you can do, and this is something Quant is really good at, is you can locate opportunities to buy delta. So you can go out and you can buy calls at other strikes or expirations, and you can sell puts, and those will give you positive delta, and they will make up and offset the money you would lose if the underlying goes up from that call. But the easiest way and the most common way that people will hedge books is to just buy stock or sell stock, depending on the delta they need. It's easy, it's usually the most liquid, and it's probably the best way to go about very quickly getting your book into a delta neutral state where you're not at risk of that fluctuation of the underlying. So let's be market makers for Sean Ambrose here. He comes in, he wants to buy 480,000 calls struck at 30 for 62 cents a share. And we say, that sounds great. Of course, half the float or half the shares outstanding. I don't see anything wrong with that. Here you go. Thank you for $30 million. Uh-oh, we're now looking at our book and we say we've got these options, the delta per share. So I'm going to use the mouse here. So delta per share is at 50 cents, which gives us $24 million down in delta. So we're now short 24 million in delta, which means in the event that the underlying stock goes up $1 a share, our book should lose $24 million in value. It's obviously going to be the profit and loss there because it'll be paper loss, but it'll be substantial. And there are definitely implications around margin and covering and all that stuff. But the current price is at 62 and the market value for our book evens out with the amount of cash we have on hand to a zero P&L. Fantastic. So first thing we do is we buy 5 million shares at $30 a share to start neutralizing our delta. This is, again, we're setting aside a bunch of stuff. We're assuming there's a 5 million share block available, that they're willing to sell it at 30. And we do this because we want to get that positive delta on our book so that we have less risk. So now if the stock moves up, we're going to lose a bunch of money on calls, but we're going to gain some money back on the shares we own. And so that's great. You know, we've now got $150 million worth of stock on the book, and we're still flat at zero because nothing's really changed relative to market value. We bought the shares. We're saying this is the exact moment it happened. So nothing's reacted. This is right after the deal closes, or rather the order closes and it fills. So the market is going to react to this, obviously. So what happens next is, let's assume that the next available price is $31 a share, right? Everything is just shifted up from our 5 million block. So now we recognize that 31 is the current price. Well, first thing is, let's look at the option. The delta per share now went to 65 cents short, which means that gamma was around 15 cents, therefore delta is at 65, which means the total delta, when we multiply the quantity times the shares times the delta per share, we're now short 31.2 for this particular delta position on that option. And of course, the price of the stock went up 50 cents because delta was 50. I'm sorry, price of the option. So now we're short this. And we have our stock, which appreciated in value by $5 million, which is nice, you know, because it's at 31 a share. But two key things to notice here. First is, we are now at a much deeper delta than we started with. We were at 24 originally. Now we're at 26.2. That's not good. And then we're also down $19 million on paper. So that's also not good. So as you can see, not a good sign. And we're only one small portion of our step in. Remember, we needed 24 million shares originally in order to neutralize our delta. So this is a real-time view of what it's like to make this market right now. This is where we are. And it's about as good as it gets. So let's just hang in there and see if we can fix this. So we're going to go buy 5 million more shares. We do that. Again, this is the moment that the transaction goes through, so we haven't accounted for anything else yet. This goes through. Of course, the market reacts to that. Delta, we're going to say, goes up, you know, arbitrarily, we're going to say it goes up to 80 cents a share. The current price is now $1.77 for that option. Our net delta is now more than $28 million in the red, which is bad. And we are down over $40 million on book. Keep in mind, this is just hedging. We're just trying to hedge right now, but we're also driving the price up because it's now at 32. So let's see what happens next. Well, we buy 5 million more shares. Yep, this is, as you expect, this is going to have an impact. So now the market reacts to that. And delta continues to march up and up, and now it's at 90. What's going to happen is you're going to get to a point where the strike price is so far in the money that the delta approaches 1. And as you can imagine, it means that you will need 100 shares of stock to hedge one option contract. And since the option contracts represent half the available stock in the company, it doesn't take long before we spiral ourselves into a situation where we effectively have to own more than half the company just to hedge this, you know, the option position we had. This is not good. BTFO is kind of the term you'd probably want to use here. It means you're blown out as the market maker. And you're in a lot of trouble because you are now down on paper nearly $5 billion on your P&L because you had to spend $6.3 billion to buy enough shares, or rather you had to spend a little less than that, but because you, or more than that rather, because you got some credit and 30 million in the beginning. The point is, this is just an absolute mess, and it's a train wreck. And the question is now, we're kind of stuck because the value of the short options, they're dependent on the price staying high, but what we have hedged is also kind of what's driven the price high. So we're kind of at a bit of a standoff between us as a market maker and Sean Ambrose here. And this is a real-time view as to what's going on, trying to figure out who's going to get out first. And so there's our book blowing up in the air. So now what happens next? Well, Ambrose is in a rush to sell his calls as quickly as possible, right? It hit 200. He's theoretically going to make upwards of $8.1 billion in profit. We'll just assume that number for now. A lot of mechanics have to go into play. But as the transactions went through, we as the market maker are going to have to liquidate our shares, because now we don't want to be long Delta either. Like, we want Delta to be neutral. So he sells some contracts, we have to sell shares. He sells more contracts, we sell more shares, and it goes down, down, down. It's going to be a drastic spiral for the stock. And I mean, this could go to zero, because all the people that sold us shares on the way back up, who knows if they want to buy them back at all? I mean, who knows if there's anything protecting us at this point? So let's look at some key price points for somebody who now has $8.1 billion in cash on hand. Well, first, you could buy your majority stake once the stock crosses below 173.44. But this is going to happen in a matter of milliseconds. So do you even bother, or do you wait till it gets to 86.72 and just buy the entire company? Or if you're feeling really greedy, you could buy almost 3 of the company once it gets back to the $30 price range. And of course, as it approaches zero, you know, what's the point? So that is, and so the question is, with this brilliant plan, do you even need the virus, right? You could just get out there and you can go after and see if you can get what you really wanted all in the first place. So the question is, does this happen? And no, it's a stupid plan. It would never actually happen. Of course it wouldn't happen. And one of the key lessons that we always talk to people about, any investor, is whenever there's a deal that seems too good to be true, or a strategy or an opportunity, the thing you ask yourself is, who's going to be on the other side of this trade? Like, who would actually take it? Like, if you can't see a reason why you would be on the other side of a trade you're thinking about, then really opportunity is not there. Like, you just got to walk away, because it's not realistic. First of all, nobody's going to take on a block trade of that size. There's never going to be a scenario where somebody sells you enough calls for you to exercise it to attain control of the entire company. I don't imagine how that could possibly happen, because of, in part, the reason for hedging that position. Second, you could break it up into smaller transactions to try to sneak your way in, kind of like somebody who wants to bet on a fight, but they don't want to put $1 billion down at one bookie. They go to 10 bookies and they bet $1 million at each, and then they go back the next day and another million, another million. But you're going to move the line if you do that, right? And so all the smaller transactions, as we saw, like, they started to push the price of the stock up, because as you bought into those calls, the market makers had to buy stock to hedge. And then as they hedge, it drives the price of the stock up, which raises delta, which means they got to buy more stock to hedge, and that raises delta more. And this is kind of what happened with GameStop and some of the other squeezes that happened in 2021 and 2022. So that was sort of the concept behind those things. And that stuff is still available to exploit at any time, and it doesn't require a lot. Basically, you get enough people together to buy out-of-the-money calls, and if the market makers are hedging that, then it goes up. But we also saw some of the interdiction that happened there. So not all the profit was necessarily able to be made in those situations. Now, market makers will also keep a very close eye on their risk, and they'll have limits. So they're not just a blank check to keep buying stuff from you. So even if you go in and you say, hey, I'm still willing to pay for these options, like, there's going to be a point when they say, well, everybody's buying calls. And this comes up a lot in the opposite direction when everyone starts to buy puts when a stock becomes hard to borrow. They start to buy puts and they want to sell calls. So the IV skews actually start to separate, where it becomes expensive to buy calls and expensive to buy puts and cheap to buy calls, because they're trying to drive demand for people to go and sell puts and buy calls in order to balance out their books. So that is another thing that is, important to keep in mind. And of course, and this should go without saying, psychic trades undergo scrutiny. So what we mean by that is that if you go out there and you place a huge block trade out of the money for a ton of options and a stock that is low volatility, and you become a billionaire overnight, there's going to be knocks on your door. People are going to look into that kind of stuff, because you can't see that coming. Like, it's very difficult to trick the SEC. Like, they have all the data. So You're not going to get away with something like this, and especially if you're doing it under duress with threat of violence and releasing viruses. There's probably some bylaws that talk about that, and if not, there should be. So anyway, I'm sorry, Sean, but your idea is absolutely ridiculous. It's an absurd thing to note. But I think one of the shining great examples in all this is that the movie critic community was really on top of this. And what they do is they actually rated all of the Mission Impossible movies based on their fidelity to options market mechanics. And as we can see, the more recent ones did better. And then, of course, at the bottom, as expected, Mission Impossible 2. I mean, this was the least accurate options-based movie in the series. And I'm glad that it's being reflected appropriately. So, in the meantime, let's get back to our mailbag. And as always, if you have any questions, if you have any feedback, if you want us to cover something, please reach out at hello@quancha.com. And in the meantime, good luck and good hunting.